Okay, today we're going to unravel one of the most complex players at the heart of the 2008 financial crisis. You've probably heard its name before, the credit default swap.
So to get the whole story, we have to go right to the scene of the crime. The chaos of 2008, when the global economy was teetering on the absolute edge of a cliff. Now, a lot of things got the blame, but there was one financial tool that just kept popping up everywhere.
And this wasn't just hindsight. Way back in 2002, the legendary investor Warren Buffett gave this incredibly chilling and accurate warning. He basically described a time bomb ticking away quietly right at the center of the world's economy. At the time, though, not many people were listening.
Well, that time bomb started to go off right in the U.S. housing market. You can see it here. Foreclosures didn't just go up, they skyrocketed. Millions of families lost their homes, and those shockwaves started spreading out, shaking the very foundations of the entire financial system.
So that really brings us to the core question, right? How on earth did one single, kind of obscure financial product, something most of us had never even heard of, become a key ingredient for a global economic catastrophe?
To get that answer, we've got to meet our main suspect, the credit default swap, or CDS. Now I know, it sounds super complicated, but its original purpose was actually pretty simple.
In its simplest form, a CDS was just a clever way to handle risk. Think about it like this. Back in the day, JP Morgan had a huge loan out to a big company, Exxon. They were a little nervous, so they paid another bank a fee. And in return, that bank promised that if Exxon ever went bust and couldn't pay, they'd cover JP Morgan's losses. Simple, right? It's just a way to move risk off of your books and onto someone else's.
So the key takeaway here is that a CDS basically works just like an insurance policy. The lender buys protection, and the seller of that protection gets a regular payment, kind of like a premium. If everything goes smoothly, the seller just keeps the cash. If the borrower defaults, well, then the seller has to pay up. It was actually designed to make lending safer. But, and this is a huge but, this simple little insurance tool, it did not stay simple for long. What began as a smart idea for managing risk quickly mutated into this unregulated multi-trillion-dollar monster.
Just look at the sheer speed of this growth. It's wild. In late 2004, the total value of loans being insured by these things was about $6 trillion. Less than 4 years later, it had ballooned to nearly $58 trillion. That is an absolutely mind-boggling explosion, and it was all happening in the shadows, with almost zero regulation.
So what was fueling this? Well, the whole purpose of the market changed. It went from what we called hedging, where you buy a CDS to protect a loan you actually hold, to pure speculation. This is the critical twist in the story. People started using CDSs to bet on the failure of companies and loans they had absolutely nothing to do with.
And this is the perfect analogy. It's like being able to buy a fire insurance policy on your neighbor's house, or on 100 of your neighbor's houses. That's exactly what was happening. You could place a bet that something would fail without owning any piece of it. All of a sudden, the game wasn't about preventing disaster, it was about profiting from it.
And this wasn't just some small corner of the market, this became the market. By the time the crisis hit, estimates suggest a staggering 80% of all CDS contracts were held by speculators, people just making bets. The original purpose was completely buried.
To pour even more gasoline on the fire, these bets were highly leveraged. What does that mean? Well, think of it this way. For every $1 an investor actually put down, they could control a bet worth $30. This massively magnified their potential profits, sure, but it also meant that when things went south, the losses were absolutely catastrophic.
Okay, so we have this massive, speculative casino operating in the shadows. How did it end up becoming the perfect accelerant for the firestorm that was already brewing in the U.S. housing market?
So the first spark was the housing bubble. You had low interest rates, really loose lending standards, and banks were handing out millions of what they called subprime mortgages. These were basically high-risk loans given to people who honestly probably couldn't afford to pay them back.
Now, Wall Street thought it had a brilliant solution for this. The banks didn't want all this risky stuff on their books, so they bundled thousands of these mortgages together into these complex bonds. They basically took thousands of little risks, put them in a big financial blender, and sold that cocktail to investors all over the world. They thought, hey, the risk is now someone else's problem.
And this is where the credit default swap comes roaring back into the picture as the accelerant. To make these bundles of bad mortgages look safe, banks bought CDS protection on them. They essentially slapped an insurance sticker on them.
And this created this powerful illusion of safety, convincing investors that even bonds backed by the worst loans were somehow a rock-solid investment.
And that created the perfect storm. This false sense of security from the CDSs just encouraged more and more reckless lending. But the risk never actually went away. It was just hidden, tangled up in this complex web that stretched across the entire globe. So when homeowners inevitably started to default, the whole house of cards just came crashing down. The mortgage bonds became worthless, and the companies that sold trillions of dollars in this insurance, like the huge insurer AIG, were suddenly facing losses they could never, ever pay. One domino hit the next, and the whole system started to fail.
The world really stared into the abyss. A massive government bailout was needed to stop a full-blown global depression. So, after all the dust settled, what did we do to stop this from happening all over again?
Well, regulators stepped in with some big reforms. The goal was to drag this whole shadowy market out into the open. To stop that domino effect, a lot of these trades now have to go through a middleman, a central clearinghouse. To fix the secrecy problem, trades now have to be reported, so everyone can see what's going on. And to make sure banks can actually survive a crisis, they're now forced to hold way more cash in reserve.
And that brings us to our final thought. The credit default swap went from a pretty clever idea to a weapon of financial mass destruction. We have new rules and new safeguards now, but in a world where financial innovation never stops, you have to ask, is the beast truly tamed? Or is it maybe just waiting for its next chance to strike?